The world's largest oil companies are making more money than they ever have in their century-long existence. In 2023, the combined profits of ExxonMobil, Chevron, Shell, BP, and Total Energies topped $200 billion. That's a record. It happened while global leaders met for another climate summit, while electric vehicle sales hit new highs, and while the phrase energy transition became a permanent fixture in corporate boardrooms. The contradiction is so glaring it feels like a mistake. A sunset industry should not be breaking sunrise profit records. This is the energy historian, uncovering the hidden systems that power civilization. To understand this paradox, you don't look at a gas station price sign or a climate protest. You look at a specific type of financial document, filed in a specific year by a specific company. In early 2021, as the world was still locked down, the CEO of one major European oil giant stood before investors and said something that sounded like surrender. He announced the company would cut its oil and gas production by over 40% within a decade. The headlines wrote the obituary. Fossil fuels were being phased out by their own producers. The stock price did something unexpected. It went up. Not a little. It soared. The market wasn't punishing the company for shrinking, it was rewarding it. The signal was deafening, but everyone heard the wrong message. They heard decline. The financial markets heard scarcity. And in a system built on abundance, the deliberate engineering of scarcity is the most powerful financial lever that exists. For decades, the oil industry operated on a simple, brutal expansion logic. Find more, pump more, sell more. Volume was king. The entire corporate structure, the massive exploration budgets, the geopolitical gambles, the sprawling refineries was a machine designed to increase the flow. Its value was tied to the size of its reserves, an ever-growing mountain of underground assets waiting to be turned into fuel. That model created empires and fueled centuries of growth, but it had a fatal flaw. It was inherently unstable. When everyone is trying to pump more, the price collapses. The industry's history is a graveyard of boom-bust cycles, each bust wiping out weaker players and reminding the survivors that abundance is their enemy. The modern oil supermajor was born from one of these collapses. The 1990s were a time of low prices and gluts. The response was a wave of mega-mergers, Exxon and Mobil, Chevron and Texaco, BP and Amoco. The goal was efficiency through scale to be so big you could survive the price valleys. But the logic was still volume. Be the last, biggest pump standing. That logic held until around 2014, when the US shale revolution unleashed a torrent of new oil. The old giants watched as smaller, nimbler companies flooded the market, crashing prices again. For the supermajors, it was a crisis of identity. They couldn't outpump the shale drillers. Their old weapon scale was now a liability. They were massive tankers watching speedboats drain the pond. The financial punishment was severe. Stock prices languished for years. Investors, tired of the boom-bust roller coaster, began to flee. The industry was labeled stranded assets. The message was clear. The old volume game was financially dead. This was the crucible. This was the moment the playbook changed forever. The companies didn't decide to die. They decided to transform into something else entirely. They stopped trying to be the biggest producers. They started trying to be the most profitable producers. This is not a semantic difference. It is a complete inversion of industrial purpose. The new model isn't about growing the mountain of reserves. It's about sitting on top of the mountain you already own and letting its value increase because no new mountains are being claimed. It means slashing exploration budgets. It means not chasing expensive, difficult new oil fields. It means letting natural production declines from existing fields happen and not fighting them. Most importantly, it means using those record profits not for reckless expansion, but for two things: buying back your own stock and paying massive dividends. Think about that shift. For a century, profits were reinvested into the ground, into more drills, more rigs, more pipelines. Today, profits are returned to shareholders. In 2023, the top 5 oil companies spent over $100 billion on share buybacks and dividends. They are systematically dismantling their own growth engine and converting it into a financial engine. They are turning oil in the ground into cash in the pocket, but slowly, deliberately. The goal is to become a cash machine, not a growth stock. The transition from an industrial empire to a financial utility. This is why the death of fossil fuels is so profitable. Demand is not falling off a cliff. It's entering a long, slow plateau. The International Energy Agency predicts global oil demand may peak before 2030. But peak demand is not zero demand. It is the beginning of a decades-long taper. In that environment, the last thing you want is more supply. What you want is controlled, declining supply that always stays just a little bit tighter than that declining demand. You want to be the last, lowest-cost barrel sold. The entire industry is now structurally aligned to create that exact condition. The high-impact realization is this. The oil industry is no longer in the business of finding oil. It's in the business of managing its absence. Look at the evidence on the ground. Investment in new oil and gas exploration has collapsed. It's down roughly 50% from its 2014 peak. Banks are reluctant to finance new mega projects. Governments are withholding leases. The industry, chastened by past losses, is refusing to invest. The result is a supply wall forming. Existing fields naturally decline at about 4 to 6% per year. That means the world needs to find the equivalent of a new North Sea every year just to stand still. We are not. The new projects coming online are smaller, slower, and more expensive. The system is now wired for a gradual tightening. This is where geopolitics amplifies the financial logic. The OPEC Plus alliance, led by Saudi Arabia and Russia, isn't just a cartel trying to boost prices. It is a partner in this new scarcity business model. Their production cuts aren't temporary maneuvers. They are permanent features of a coordinated effort to drain the global buffer. When the US shale boom provided a shock of new abundance, it threatened this model. But even shale has changed. Shale drillers, burned by debt and investor pressure, have also switched from growth to capital discipline. They are pumping less, returning more cash. The entire global supply chain is now governed by a principle of restraint. So the paradox resolves. Fossil fuels aren't dying in a competitive, disruptive free-for-all. They are being deliberately and profitably managed into a long, lucrative sunset. The companies are richer than ever because they have stopped fighting the transition and started financing it on their own terms. They are using fossil fuel profits to fund shareholder returns, and some are even using them to dabble in renewables, not as a replacement, but as a side business. The core asset, beconsumonganic den Lombier, the oil and gas chimils, Wiking Stedens coals, but manaston longan the mitimely sherry and term emial. This leads to a second, deeper realization. The energy transition has a hidden landlord, and it's the old energy system. The capital required to build a new world, the trillion-dollar investments in grids, batteries, solar farms, and EV factories, is staggering. That capital has to come from somewhere. Right now, a significant portion of it is flowing from the record profits of the oil and gas industry, not as investment in renewables, but as cash payments to pension funds, institutional investors, and sovereign wealth funds. These entities then reinvest that capital across the entire economy, including into new energy. In a very real sense, the fossil fuel system is funding its own replacement by converting buried carbon into financial liquidity. It is monetizing its own decline. This creates a perverse dependency. The faster the old system cashes out, the more capital is available for the new one. But that cash out depends on high prices for the old commodities. So, we need high oil and gas prices to fund the transition away from oil and gas. The system is caught in a financial feedback loop, where its declared enemy is also its primary funder. This isn't a conspiracy. It's a structural inevitability of a capital-intensive global shift. The final unsettling realization is about time. The financial markets are rewarding a 10-year scarcity story, but the physical climate system operates on a 50-year carbon budget. The two timelines are catastrophically misaligned. The profitable, managed decline of fossil fuels is still far too slow to meet any serious climate target. The industry has found a way to make the end game extremely comfortable for itself, while the physical system careens toward greater instability. They are not denying the transition anymore. They are banking on it being slow, orderly, and immensely profitable for the last owners of the old world. So we arrive at the true, reframed question. It's not, why are oil companies rich if fossil fuels are dying? It's, what happens when the system designed to phase something out makes more money by phasing it out slowly? The incentive is no longer to resist the transition, but to control its speed, to throttle it to a pace that maximizes extraction of wealth, not extraction of fuel. The infrastructure of the old energy system has found a new product, time, and it is selling that time at a record premium. If this gave you a new perspective, hit subscribe. The hidden infrastructure is always there. Now you know where to look.